Welcome to SB Talks. Today is Monday, March 23rd. I'm Vincent O'Neill and I am joined by our Chief Investment Officer, Nick Ryder. Welcome, Nick.
Thank you, Vinny.
Now today, Nick and I will be discussing the continuing conflict in the Middle East and the key considerations for markets and portfolios, as well as touching on last week's RBA rate increase. Welcome to all our listeners. Really only one place we can start this week, and that is unfortunately the continuing developments in the Middle East. The last time we recorded, there were signs of optimism, of de-escalation. Trump references to an excursion and many of his objectives have been completed, but since then, unfortunately, that has not been the case, with continued attacks and attention now very much on the choke point that is the Strait of Hormuz.
Yeah, I think, obviously the Iranians have asymmetric power to basically block all ships going through the very narrow 33-kilometre Strait of Hormuz, and they've been exercising that. I think, it's put the president in a very difficult position. So the only way to really kind of deal with that is potentially deploy troops. And there are reports that troops are being sent to the Middle East, and all that does is give more evidence that this could be a longer, more drawn-out process. So I think that's where markets are at, even though there's rhetoric that came out last week, we're almost done, and the Israelis, Benjamin Netanyahu, sort of indicated that.
Yeah,
but then
Thursday night. Yes.
But then over the weekend, we've had threats from Trump on, potentially targeting Iranian electricity infrastructure and power, and then they've retaliated and said they'll target energy infrastructure and potentially desalination plants in Gulf neighbours. So I think for the Iranians, this is quite existential in a way, So
maybe we're pausing for a second because there's just so much in all of that. At the time that we record here, it is Monday morning in Sydney, Australia. The threats that you talk about in terms of attack to Iranian infrastructure, if the straits are not opened, were Truth Social posts made over the weekend, which the Iranians responded to by, I guess, in kind, making their own threats. Now those threats had a 48-hour timeline on it, and I suppose we're probably roughly halfway through that, if not a little bit further, but we essentially are in a moderate state of limbo in regard to whether that next stage of escalation is going to play out, but it's certainly not an immaterial risk as we sit at this point.
No, absolutely not. And as I said, all it does is show that this is going to potentially even escalate further. And Treasury Secretary Bessent said, we might have to escalate to de-escalate. So it just shows that this maybe is going to drag on for a bit longer than what we'd originally thought, and perhaps what the market had originally thought.
So key risks around that, beyond, I guess, broader escalation and the potentially humanitarian impacts, are obviously to global energy supplies. So the Straits responsible for the transport of huge quantums of oil and also gas. But we are also seeing some attacks on oil infrastructure, such that even if we did have a de-escalation from here, that there might be some permanent damage done. So, for example, I think 16% of the LNG production capacity at one of Qatar's facilities was caught up in one of the attacks.
Yeah, well, that's right. The International Energy Agency has said this is probably the most severe disruption to global energy supplies we've ever seen. That even if the de-escalation and some sort of ceasefire, it would possibly take 6 months for energy supply to ramp up to where it was before the 28th of February. So you're right, this is potentially quite disruptive, and it does have some echoes maybe to the oil shocks in the 1970s.
And the potential inflationary impacts and the risks of stagflation, which we've talked about before. Now, interestingly, you guess you paint potentially quite a bleak picture there, or certainly a one of higher risks. Markets have been, I don't want to say benign towards this, but the oil price has shot up on a couple of occasions over recent weeks, but then with following sort of statements and actions has sort of ebbed back somewhat. And equity markets, if I compare what we've seen in the last few weeks to, for example, approximately a year ago, Liberation Day tariff announcement, and I think there, peak to trough, the S&P 500 was down somewhere in the vicinity of 12-13%. We haven't quite seen that level of market reaction yet. Is that unusual?
No, I don't think so. I think, there's still an assumption that this is only going to be fairly short-lived. I think that's the base case that the market and investors and economists and strategists are working on. It's certainly the one we discussed on our last podcast, that we expect this to be sort of measured in weeks rather than months or years. And so, what we normally see during any kind of geopolitical event is, based on history, is sort of 6 to 8% pullback in equities. Typically, they would bottom sort of 3 weeks after the outbreak of hostilities or whatever it might be, and then sort of fully recover after that. So that's the playbook that I think a lot of investors are clinging to. Now, whether this kind of looks like the average geopolitical shock that we've seen in the past remains to be seen. But I think investors really are not kind of embracing the idea that this is going to lead to a longer lasting stagflationary shock like the 1970s, which lasted for many, many years.
And I guess the key factor in that is limiting the damage that is done to energy infrastructure in the region, not significantly beyond what we've seen to date.
Yeah, I think that is key. Now, I think I might have mentioned on the past podcast that there are other suppliers of energy, Russia being one, Kazakhstan. So there is other options to get energy, not just from the Gulf states. So there is that.
Russia is an incredible winner out of all this.
Oh, absolutely. They're the only winner at this point. So I think, we just have to kind of watch how it goes. And the US, for example, they're net exporters of energy. So, of course, prices there have gone up. Now, West Texas Intermediate crude prices have not gone up as much as Brent, which is European oil prices. So that's just showing that the US is in a relatively good position. And
in terms of their insulation, and they've got enough internal supply to meet their demand.
Yes, they do. And, and the US equity market is actually down less than, say, Australia's equity market. So there are some regional differences. Obviously, Asia is a big importer of Gulf oil, Japan, Korea, China. But there's talk that the Iranians may let those cargoes go through because they're not seen to be part of the, Israel-US alliance attacking Iran. So there's anecdotes that they potentially letting some Indian supply through, potentially some Chinese supply. So I think we just have to see how it goes. There are reports that potentially even if the US and Israel were to pull out and say, "Oh, we're done," the Iranians could try and use almost like a toll road, charge boats going through as a way of generating income to help kind of rebuild
their economy, rebuild their country. Yeah. So I must ask you to put your Chief Investment Officer hat on before this, because we sort of talked a lot of geopolitics and touching on markets. But how do you think about the appropriateness or otherwise of making, I guess, more substantial portfolio changes given the uncertainty in the outlook?
Well, you never want to make a knee-jerk reaction in this case. As I've had clients ask, kind of where would you, if you were to do it, what's the asset class that sort of, is the best protection? And unfortunately, it's cash. Cash is really the only place to hide. We've seen bonds sell off. We've seen equity sell off.
And gold?
Even gold, meant to be this sort of fabulous inflation hedge and hedge against geopolitical risk. Well, it's down almost $1,000 an ounce since its peak in earlier this year. So I think it's only really cash, and we know over long periods of time, cash is the worst asset to hold,
particularly in a potentially inflationary environment.
Well, it can be okay in an inflationary environment. So in 2022, it wasn't bad. In the 1970s, it wasn't bad. Kind of on a even after deducting inflation. But we certainly wouldn't advocate clients sell all their assets and go into cash. So So what we've tried to do, as I mentioned 3 years ago, we rebuilt the portfolios to have a bigger allocation. Approximately 25% of portfolios, of balanced portfolios, now exposed to alternative investments, things like hedge funds, and another sort of 10% allocation to real assets. So that's things like infrastructure. And they're assets that can potentially provide a degree of diversification and inflation protection in an environment like the 1970s or 2022.
So you're sort of setting a picture there where I guess it's very hard to make, with any extreme confidence, predictions in the short term, and we're not here for a second trying to predict what's going to happen, unfortunately, in the Middle East. More that portfolios are built with times like this in mind, such that we're not foot to the floor on the accelerator down going into it, that you need to make a knee-jerk reaction because you're going to be caught up in it.
Yeah, and we came into this neutral, so we certainly weren't overweight equities. Our view in our 2026 outlook was cautious optimism. You know, we talk about the underlying economic tailwinds and corporate earnings growth that have been quite strong. So that those things are still there at the moment. So we still think, you know, stay invested. Generally, every year we would get maybe a pullback
of
10% pullback. That's pretty standard every year. What is less common are bear markets, 20% plus pullbacks, and we don't think we're at the start of a bear market. This feels more like a regular 10% pullback.
But obviously one that we are monitoring very closely, watching daily, because it is unfolding.
No, absolutely.
Unfortunately, in real time in front of us. I might step away and closer to home. The RBA had to raise rates once more. What's your take?
Yeah, I think after we got some of those inflation numbers, it was really, most economists and markets had priced in, I think, a 70 or 80% chance of a rate hike, and they delivered on that, although it was line ball. So it was a 5-4 decision, right. So quite a close run thing. Apparently, according to Michelle Bullock at her press conference afterwards, the people that were more advocating for a hold, the 4 voters, for them it was more about timing rather than direction. They perhaps wanted to see more data to get more confidence that inflation was getting away from them. So she described them as more like a hawkish hold. But I think the issue was, leaving aside what's going on in the Middle East, we know that capacity constraints are causing inflationary pressures in Australia. Unemployment has been sort of trending sort of sideways around 4.2% for last year or so. The economy is going reasonably strong, growing reasonably strongly, particularly at the end of last year. So there was sort of price pressures building in the economy before the conflict in the Middle East. Now, what they're worried about is that when you get oil prices going up and potentially food prices because of transport costs and fertilizer costs, you get what's called a sort of inflation expectations. So people now start to expect inflation, and then they start to ask for pay rises, and it just becomes this sort of wage price spiral that
which we experienced a bit of coming out of the 2022 sort of COVID era, and it sort of worked its way through the system, but we saw a few tail effects maybe there combined with more recent factors bringing us back to this position again.
Yeah. So generally central banks will look through a supply shock or an oil price spike and say, oh, it's temporary. But what they are more concerned about is inflation expectations. And so we've seen last week, we had the Fed meeting, the ECB meeting, the Bank of England meeting, and the Bank of Japan, and they're all pretty much sort of saying the same thing. They're not saying that we're going to hike rates, but maybe they're saying, well, we're concerned, we're watching inflation expectations, and if we need to act, we will.
A very helpful update, as always. Thank you, Nick. We are conscious that these are unsettling times, and we encourage you to don't hesitate to reach out to your advisor and talk to us regarding implications for your portfolio or positioning more broadly. But thank you, Nick, and thank you to all our listeners.